Okay, so once again, my name is Candice Reynolds. I am a financial advisor at the Garden Life Limited company located in Montego Bay, Fairview. And tonight I'll be presenting on the topic, unlocking the treasures of your life insurance plan, unsought but precious. Today I was thinking about a friend of mine who told me a story about when he was younger and he got a gift. It was a book and he wasn't a reader. So, he just put it down because he wasn't interested in it. And years later, he just took up the book and started to read it. And while reading it, he found some US dollars in it. This story is so familiar to the stories that I hear when I speak to persons about their life insurance plan. I say to them, they say to me that they have a life insurance plan, but they can't tell me what they have. They don't understand it. They just know that they have something, right? And so I hope tonight, I won't be able to go in details with everything, but a general sweep of some principles and some concepts of life insurance so that you are aware of what you're purchasing from the company. All right, so in Luke 4:18, Jesus declares, "The Spirit of the Lord is upon me because he has anointed me to proclaim good news to the poor. He has sent me to proclaim freedom for the prisoners and recovery of sight for the blind, to set the oppressed free." This is the heart of the gospel. The good news communicates your freedom, deliverance, and restoration in every area, including your finances. The good news is that God wants you to be financially healthy. Do you believe this? And when I say financially healthy, I'm not necessarily talking about being a Bill Gates or having millions of dollars. Persons with millions of dollars can also be financially healthy. When I say financially healthy, I'm talking about the mindset that one has towards finances, first of all, and secondly, the financial intelligence to be able to manage their valuables in a very effective and efficient manner. So there's somebody who may be earning $1 million every month and somebody who is earning just 100,000, and that person who is earning 100,000 can be more financially healthy than the one who is earning $1 million. God doesn't just tell us that he wants us to be something. He also draws alongside us and empowers us on the journey. So you're not left alone in this financial journey. He has sent the Holy Spirit to help you along the way, right? Studies have shown that persons who have high financial well-being are less likely to experience health challenges. Whereas persons with a low financial well-being, they experience stressful situations. They have a high stress level because of their inability of reaching an income level to meet their needs, especially their basic needs. This can affect them mentally and physically. The underlying economic problems of financial stress cause disorders such as irritability, that is somebody who is easily angered, impatience, apathy, emotional distance, loss of professional enthusiasm, stomach ulcers, muscle tension, insomnia, headache, anxiety, and depression. No, this doesn't sound like somebody who is prospering and being in good health as their soul prosper. Because if in one area, if you adapt what Dr. Cole said in the first week, and then you're still financially stressed out, you might just go back to square one. So we are doing this because it is very important, and you can see why God wants us to be financially healthy. And you have to believe this. Financial stress can cause an individual to dedicate a significant part of their time and mental effort to cope with financial difficulties. When last have you been to a prayer meeting and a financial request is not on the list? What if one day we come to a prayer meeting and a financial request is not on the list? That would be good, right? But there are some persons, for some reason, they are in a cycle of always having financial difficulties, always having financial difficulties. It can also negatively affect job satisfaction, and it contributes to burnout syndrome. Financial difficulty is today considered as one of the leading causes of divorces among families, right? So two individuals come together, they have two different mindsets towards money. One is a little more financially intelligent than the other. One might love to spend, and the other one might be thinking more of the future, putting something aside. And sometimes this can cause friction if couples are not willing to compromise, and it can lead to a dissolving of the marriage. So far we have learned that it is God's will for us to be financially healthy. And financially healthy does not necessarily mean having a lot of money. It simply means believing God wants you to be financially well, having the right mindset towards money, and having the financial intelligence to manage the valuables that God has blessed you with. So like Peter, some of us is saying, give me more faith. Like Peter said, give me more faith. Some of us are saying, God, give me more money, it will be better. But then God give you more money, but you don't have the financial intelligence to manage it. And then you're back to square one, asking for money again next week. And so we have to deal with the foundational, the root of the problem. And I believe that this week, as different presenters come on, you will be able to hear some more about that. Steps you can take to become financially healthy. Firstly, pray and seek God's wisdom on proper stewardship of your valuables that He has blessed you with. All right, somebody just marked up my screen, but I'm going to continue. I think it was probably by accident, somebody did that. Educating yourself financially. Your financial situation will not change until you decide that you're tired of being tired. You're tired of always being in a financial slum, right? And so if you're really tired of being tired, you want to educate yourself on finances. One way of doing that is firstly by coming tonight and this week to the financial portion of the seminar. So you're learning strategies in terms of how to overcome difficulties. You can also purchase books, invest in books, and educate yourself financial, because ignorance is more costly than knowledge. Speak to a financial advisor who you trust, and also put into practice what you learn along the way. So as you're praying, put into practice. As you're praying, put into practice. So there are different financial instruments that one can use to attain their financial goals. Now, your goals may be short-term, medium-term, or long-term. And it depends on your goal. Now, depending on your goal, then you will be able to decide which instrument to use to meet that goal. Now, it's not one or the other. Your financial planning should consist of a combination of these things. So, for example, your short-term goal, maybe monthly expenses. All you probably need for that is a savings account. And I believe one of my colleagues will be speaking on that this week. Or you need some money that for emergencies. Short-term goals is anything between 1 and 12 months. Medium or long-term goals, any financial goal that you have that is 1 to 5 years. For example, you want to buy a home, you can use financial instruments such as a fixed deposit account or certificate of deposit accounts that allow you a little more interest on your money as you're saving towards those plans. And then for your long-term goals now, you need an instrument where, because it's long-term, that can give you a higher return as you save in this. So life insurance is one of the long-term financial instruments. Sometimes we mistake a life insurance for a savings account. So we want it to be short-term when it was really created to be a little more long-term. And so sometimes we can become frustrated with the whole idea of a life insurance plan. What is life insurance? Life insurance allows individuals to safeguard their families against the financial misfortunes which occur when a breadwinner dies prematurely or suffers total disability, which renders him or her unable to work. So a life insurance is used like an income replacement. It is used to guard against economic loss. So if you are the primary breadwinner of your family, you're the one that is bringing in the money, buying the food, paying the mortgage. If something was supposed to happen to you today, who would pay the mortgage? Who would buy the food daily for your family? And so life insurance is like you're purchasing future income in the event that while you're earning, you die prematurely, right? So your family will be taken care of financially, even if you are supposed to pass away. A life insurance contract is a unilateral contract. What that means is that, firstly, you have to know what a contract is. A contract is an agreement, a legally binding agreement between two or more parties, right? And so the unilateral contract is where only one party in this contract makes a promise to perform, make a promise to you. So for example, the life insurance company is the only one who makes a promise. Say in the event of any death or any illness, I'll pay out this amount of money. And that promise is legally binding. It is enforced by law. They have to keep that promise. However, on your hand, you're not legally bound to the contract. You can always cancel your policy, whatever, because you did not make that legally enforceable promise. So the insurance company cannot sue you if you decide to cancel your policy. However, you can sue them if they do not, if everything that you give is okay and they are not paying you your money, you are in a position to sue them, right? So the primary purpose of a life insurance plan then is for protection, is for safety. It is safeguarding your economic value. Now, you can't put a monetary value on life. Just like, for example, if you have your car, you know, the car worth $1 million, so you take out insurance for that. And if anything happens, the insurance company pay you back. You can't do that with life, but you estimate in the event that something should happen, this is what my value would have been if I was still around, and you purchase that in life insurance. So it covers the basic need according to Maslow's hierarchy of needs, of the need for safety and security. Now, you are signing a contract and sometimes you don't know some terms. So sometimes some persons just sign the contract and they don't even know what they're signing. They don't know their rights. They don't know what happens if this happens or if that happens. And then sometimes some persons can't find their agent to explain certain things to them. And so they just put down the contract after they sign, like how my friend put down in book after and get it, and don't understand that there are some treasures within that contract that you can use to your benefit. So let's just go run. I'm just going to briefly run through some terms. There are quite a few that I have, but because of time, just going to briefly run through a couple. So the life insured would be the persons whose life is being insured. For example, the breadwinner. The policyholder is the person who owns the policy. Why I separate them is that the policyholder can be the life insured, but the policyholder also does not have to be the life insured. The policyholder can be one, for example, a father who takes out life insurance on his child. The child then is the life insured, but the father owns the policy, right? And in order for somebody to take out an insurance on you, they have to have some form of insurable interest. And we'll get to that term shortly. The insurer is the registered company that is providing the coverage. Material misrepresentation. Now, there are some things that you can get away with when you're applying for insurance that don't really affect the assessment of your profile. Because after you present some information, for example, to me, a financial advisor, about yourself, I have to send it to some persons called underwriters who assess you to see how risky you are and if they can insure you or not. Now, if you fail to disclose certain important information to me, so for example, you fail to disclose when I ask you if heart disease run in your family, and you know that your mother died of heart disease when she was 50, and you say, no, and you know, like you're doing it intentionally, and I put it on it, and then later on now you die from heart disease within around the same age. That is referred to as material misrepresentation, and it can cause it gives the insurance company the right to say they will not pay your claim. So you have to be careful, just be truthful and upfront when you're doing your application. All right, so your premium are those payments. This is your performance part of the contract now. So once you are paying your premium, your monthly payments, then your policy stays in force. Once you stop paying it, then the policy stops, right? But it doesn't just stop, so, and we'll get to that in a while. So when they're calculating your premium, they don't just say, okay, I don't like Candy, so I'm just going to give her a big premium of 20,000 monthly. And then I like Pastor Moses, I'm going to give him 5,000, right? No, what they do is that they have categories that they put people in terms of the type of risk that you are, because remember, they're covering risk. They're covering in terms of when you're going to die. They don't know when you're going to die. So that's why they ask for this information to assess something called a rate of mortality, right? So they place you either in a risk category called standard, means that you're average, you get it at the average rate. Substandard means that you're above average, you're a little more risky. And preferred means that you are very low risk. You have a good lifestyle, you know, drink alcohol, you just keep yourself good and nice and proper, right? And the decline risk is where you're too risky for the insurance company to take on, right? So some factors that they take into consideration when they're determining your premium are your age, your health, your smoking habits, hobbies, occupations, other things like that. So I'm sure that after listening to Dr. Cole's presentation the first week, all of us going to be at either preferred rate or standard rate, right? And if you were at substandard rate, when you go back to apply for your next policy, you'll be at preferred rate because you're putting the information in practice. Insurable interest. The insurable interest was what I just talked about. If a father takes out an insurance on his child, that is because he has insurable interest in his child. Insurable interest means that the beneficiary who is going to benefit from the proceeds of the insurance, they stand a chance to suffer financial loss in the event of the untimely death of the person whose life is insured. So a husband can insure the wife, a wife can insure the husband, parents can insure children, grandparents can insure grandchildren, because they stand a chance of financial loss if the person dies. So anybody can just go in and walk in and say, I want a life insurance policy on this person or that person. And the beneficiary, you can have as many beneficiaries as you want, is those persons that you put that if anything happened to me, this is the person I want to get it, and this is the percent I want them to get. Sum assured is just the amount of coverage that you purchase. All right, so I'm going to run along. There's something that I wanted to show you. All right, let me just go through this one first. Incontestability. Now, when you give an application to the insurance company, they have 2 years to contest, to investigate the truthfulness of your application. If after 2 years they can't find anything wrong, that it was fraudulent, or you provide any wrong information to get low premium or all of that, then after 2 years they can't contest it, right? They have to pay your money, right? And a suicide clause and all other persons, they're very sneakish. So what the insurance company does is that they put a clause in that if you take out a policy and you should commit suicide within the first 2 years, the only thing that your beneficiary gets is just the monthly payments that you have been making. However, if suicide is committed after 2 years, they have to pay out the sum assured. And by the sum assured is the amount that you're covered for. Some persons think that if they don't make a payment, the policy is going to lapse. Just to clarify, that's wrong information. With every insurance company, they give you a grace period. So if your payment is due this month and you don't have the money because you have to probably pay another bill, you have a month extra to pay it and you will not be penalized. Also, even if after that month you don't get to pay it and the policy goes into arrears, you have 6 months to pay it up before you reach what is called something that is needed called reinstatement. Now, within that 6 months, if you pay it up, you don't have to prove to the insurance company again that they can insure you. That is doing medical again and go through the whole process. But if after 6 months now, then you have to go through another process called reinstatement. Reinstatement is where you get the opportunity. You have 3 years to reinstate your policy. And so within that 3 years now, it's at the company's discretion whether they're going to take you back or not. But you have that 3 years, right? Right? Not a right. It's not your right. It's the insurance discretion. So let me not use that word. It's your right. So you have 3 years to reinstate it. However, you have to once again prove insurability, and also you have to pay up all of those back monies that you were outstanding, right? So those are a few things that we learned. Let's go to the nice part now. You have an insurance policy and you wonder, what is this thing? What are the different things that I can do with my insurance policy? All right, so I'm not seeing my screen. Somebody kicked me off. But let me share it again. All right, so what are the treasures? What are the goodies that are in my life insurance policy? Now, normally some persons just think life insurance is just when you're dead and you pay funeral money and all of that. Yes, that is included, but that's not the only use of a life insurance policy. So let's go through quickly. Final expense, yes, is one. Final expense is an unavoidable cost. So since you know that's an unavoidable cost and it is coming, just like how Joseph in Genesis knew that the famine was coming and put down something for the famine. Now wait till the famine come in, buck up in night. It's the same way through a life insurance plan. You can put down something in small installments monthly, so that when that expense come, the insurance just clear that. And it's not just clearing funeral expenses. Some persons leave bad debt that don't die with them, because sometimes they tell you that you loan them dead with you. It's not all of them die with you. Bills that are outstanding, doctor's bills, all of those things. I know that a couple of you probably have gone through some funeral. My grandmother had a funeral for her. It cost over $1 million, right? And what happened is that she took out an insurance like a year before, and this was insurance money that cleared those expenses, right? So it's very important to have for that. You can also use your life insurance to create generational wealth. There are some people, what they do is that they start in life, they start at 0, and then they go up to, for example, 10 million, and they have children, you know. And then when they die, they die at 0. So the child comes and have to start over from scratch and build again at 0. And there's no perpetuation of wealth. What the life insurance allows you to do is to create generational wealth. Wealthy people, they intentionally, in their financial planning, utilize this benefit of the life insurance plan because they want to pass on a legacy. They want to leave an estate to their children. And even the scripture we see in Proverbs 13:22, a good man leaves an inheritance, not to his children, which is good, you can leave something to your children, 2 generations down to his children's children, right? So the plan can be used for that purpose. Another goodie that the life insurance plan can do is when it comes on to estate duties. Now, estate is whatever you own, especially at death. Now, what some persons don't know, or some persons may know it, is that at death, when you die, whether you have a will or not, whatever you own have to go through a legal proceeding. So whether it's going to go by way of probate, meaning that you had assigned an executor, etc., and they are going to validate now they're going to validate that the will is authentic. And what happens with this is that the creditors, bills, all of that have to pay before your survivors get any money, your spouse or your children. And sometimes that process can long and drawn out. So what some wise persons have done is that because they know that life insurance is a social plan, that means that it's protected by law, it protects the beneficiary by law. The proceeds from your life insurance plan can easily pass on to your beneficiary without having to wait on the will to be finalized, right? And so the creditors can't come to the life insurance and say they're taking your beneficiary's money. No, they are protected by law to have that money. And so by buying a life insurance plan, you can create your own self-administered estate, right? So that your family have immediate cash at death to take care of immediate expenses, and also to clear some of that. But let's go on to the next one. It also expedites the settlement of other parts of your estate. Now, just a while ago, I mentioned that your estate have to go through some legal proceedings. For the money to be transferred to your survivors, like your spouse, your children, whatever, there are something called estate taxes. Now, you can decide if you're going to want your everything we work for all of a year, for all of your years, dissolve out, then they liquidate it to take care of estate taxes, like forced liquidation, or you can simply look ahead, look at what you own, the estate that you have, and determine an estimate of what the taxes may cost and do that through a life insurance plan. Save up for it so that at death, your survivors, your spouse, etc., can easily take that life insurance money and pay off your estate taxes, any bills, any creditors, and easily get what is in your will. Right? Life insurance can also be used to take care of business needs. So for example, I'm going to trouble Pastor Moses and use him, right? We're good like that, right, Pastor Moses? So for example, Pastor Moses is a very crucial person in DMI. He's like a key man. So you have your key man people where they can be difficult to replace if they should pass. So what companies do is that they insure these people in the event that they should pass, the time that is going to take to rehire somebody and get all of that and whatever, they're losing production, they're losing money. And so the insurance money can take that place until they find a replacement. So it's called key man insurance. Also, if you're in business with somebody, you're in partnership, and it is very important that both partners insure themselves. In the event that one of you pass away, and the family members of the partner that passed away don't want to continue the business, instead of the business just dissolve after no build, spend out years, build the business, what you can do is you can use the insurance proceeds that comes from the partner's death to buy out the family, to buy out the partner's side of the business. So instead of the family sell it to somebody else, you buy it and you keep the business going. All right, so education need. Life insurance is also important for education. There are different ways that you can help your child to meet their needs, to go to school, to go to college, etc. Some children can't go to college because they don't have any money. They want to be doctor, they want to be lawyer, they can't be doctor and lawyer because they have to set up to work at the call center. Nothing is wrong with working at the call center, but there are many persons there who would have loved to further their studies and they can't because of money issues. How do we eliminate that? Because education, as you see on the screen, is arguably the most important factor in attaining economic development. No country can achieve sustainable development without a substantial investment in human capital. So you as a parent, there are different ways to pay for the education. The cost is not avoidable. So you can either wait until it's time to pay the education and pay it out of your pocket. It will be very hard and difficult. You can let the child work and study, and I've done that and it's very difficult. Or you can look a few years ahead, determine what the child's dream is, what they want to become, see what it costs now, estimate, put on some portion money, see what it may cost in 5 years, 10 years, and use the easier terms of life insurance to pay a little on it until the child is ready to go to college. They can get that money. Retirement income, right? I meet young people sometimes and they say, I don't know what I'm doing to life insurance policy. I don't have any dependents, whatever. Fine, you don't have any dependents, but I'm sure you're going to retire one day. You're planning to retire, you want to have a good retirement, you don't want to work twice as hard when you retire. An insurance plan is something that can alleviate that. So what some persons don't know, or they may know, is that when you pay pension, for example, your company take 5% and they put it towards your pension, whatever. When you're ready to get your pension, that money is going to be taxed, right? So what you can do, instead of putting just relying on that or putting all of that there, you can use cash generating life insurance policies that you can accumulate cash value in to save towards your retirement, because these monies are not taxed. And so you can have tax exemption, right? So when your money is paid out, so for example, somebody in their 20s, they are not interested in insurance or protection. They never check the child. They said they just want to save it for their retirement income. They want to, they'll probably pay, like, for example, a 23-year-old, several $7,300 because they are in saving for their retirement. When I did my calculation at age 65, accumulated cash value in that would be around $20 million, and that is tax-free. Additionally to that, the person also still have then coverage of 3.5 million, the accident benefit, and So it is a good plan. It is a good tool that you can use to save towards your retirement, because some persons, they save towards their retirement and it's not sufficient when they reach the retirement. The money have to spend out either on long-term care or other things when they never expect to come into play. Have some supplement income that is not taxable, and this is one of the ways you can do it. And the main purpose of life insurance, family protection, right? So you want to ensure that if while you're building your estate, suppose you don't get to finish build your estate, you die prematurely. So what you can do, you can purchase future income through a life insurance plan and purchase it upfront and then build your estate. Use the insurance as a foundation, because tomorrow no promise to anybody. And you have dependents. Some persons have the person depending on their income. Ensure that their futures are secure financially through this tool. Just going to breeze through because I think I just have a few minutes left. There are two basic types of life insurance. You have term and you have permanent whole life insurance. The term life insurance is a temporary insurance. It's like living in a rent house. You don't own it, right? It covers you for a temporary period of time. Some persons use this, for example, if they have young children and they want to cover themselves until the child finish college, right? So when they finish college and the money pay off and whatever, and they don't die before the child finish college, then they end them plan and then say, okay. There are other persons who use it, for example, first-time homeowners. Life insurance is compulsory. Some persons use it if they take out a mortgage loan and the mortgage loan is 20 years to pay it. They take out a term insurance that says 20-year coverage. And when the loan done, the plan finished. There are other persons who don't just want that. They want more. They want more of their insurance plan. And so they go to what is called a permanent life insurance that covers you for life, right? And while you're being protected or your family is being protected, cash value, as you pay your premium, there's cash value that is going into your life insurance. It's like a house. When you buy your house and you're paying your mortgage, you're building up equity in it. And there are different states and different countries do different things. There are some persons where you can use the cash value in your life insurance to take out a loan, borrow against that cash value. There are some persons who don't do that, but at the same time, you still have your cash there that you can use, right? So that's the permanent insurance. The question is, how much insurance do you need? Some persons may ask. Well, it depends on the stage of life that you're in. Different situations are different. It also depends on your budget and it depends on your goal. Take, for example, a man who is probably in his 50s. He has built most of his estate already. He has a lot of assets, a lot of bonds, a lot of stocks, a lot of things, And his primary purpose, probably for life insurance, would be to take care of the estate taxes so that at death, they don't force the liquidation of his bonds and stocks, selling it below the value that it valued just to get money to pay the estate tax. And so he would, in his estate planning, he would buy a life insurance to take care of estate taxes, right? For example, somebody who is married with 2 young children, just start out, they don't know if they're going to make it to 50. Right? But they have young children. So what they do, they might purchase insurance for the purpose of family protection. So they buy up a lot of future income. They look at what, if I'm supposed to die today, there's still mortgage to pay, there's still food for my children to get, they need clothes, they need this, and they calculate the expenses. And from that, they just purchase a policy of that amount, have it in place while they're building their estate, buying investments and all of that. So it depends on where you're at. Your financial advisor will work it out with you. Many persons that I meet, they're so comfortable saying to me that when I ask them if they have life insurance, they say, yeah, man, my company cover me, me good. But what they don't know is that some of them have been working for these companies for like 5 years, 10 years, 20 years, and they have life insurance, group life insurance, and they feel good. But the disadvantage to that is that if you should leave that company, the insurance don't go with you. And then your family is left out in the cold and you are left out in the cold. Number 2, if you're there with the company for 20 years and it's just group insurance you have, you're 20 years older. So whatever premium you're going to get now from a life insurance company, you're going to be at a higher rate because your age, because the younger you are, the cheaper life insurance is. You're 20 years older, you did not take out one for yourself, you're depending on this company, and you're left out in the cold. So my advice, while your company is covering you, take out a personal life insurance for yourself, buy your own estate, because insurance is like you purchase an instant estate for yourself. You never know if you'll be able to pass on anything else, but at least you have your insurance proceeds that you can pass on to do whatever you want. That's yours. You have it up front, right? Why a claim could not be paid. Some persons might hear process say, the life insurance never pay me the money and all of that and whatever. Remember that the life insurance has 2 years to contest your application, to investigate the truthfulness of it. So within these 2 years, so for example, somebody dies within that 2 years and they tell the life insurance company that there's no heart disease that run in their family, and they die from heart disease, like when they're 30, like 2 weeks later, 2 months later. When they investigate and find that out, that can affect your claim, that can affect your beneficiaries being paid out because you were not truthful, right? And you can nullify the contract. Remember, it's a contract. It's not some dolly thing that you just put up and you say, okay, we're drafting something and we're playing dolly house. It's a contract, right? And so the insurance company has rights and you have rights, right? There are different things that can also prevent the claim from being paid out. Please choose a company that is financially sound. Look at their track record, look at the soundness of them financially, see that these are companies that will be around for a long time, because it's a long-term savings account. And so you want to ensure that your companies are around a long time so that your claim can be paid out to your beneficiaries, right? And when you're looking at those financial statements for the company, don't so much look at their income, which is good. Look at the assets, because some of them can have a high income, but they're not spending the money right. They don't have the financial intelligence to manage that money. And so they have a lot of liabilities, a lot of debts, and they don't have, you understand? They don't have a lot of assets. So look at that. So how do I start? First of all, do your research on the company that has a good track record and reputation. There are different sites that you can go to find out the top companies that you can use for life insurance, right? That pay the commitment to the client. When a claim is ready to pay, they pay it out. So that can be taken care of. Also, pray and ask God's guidance to lead you to the right one, because there are a lot of agents out there who say, choose me, choose me. And it's not about choosing an agent, it's about choosing a company that is financially sound, right? So even if your friend Candice Reynolds work at Guardian Life, you have a responsibility to check out Guardian Life to see if Guardian Life is financially sound. And I can say with confidence that they are in the top, that are financially sound and have a good track record, and you can check this out for yourself. And after you do that, then you choose the agent, because the agent can leave, right? But the company will be there with your policy and your money. And then you speak to an agent and ask for different quotations based on your needs, based on your goals. Let them give you what it would cost you to get a plan at your age. You can also get, even if you're not healthy, you can get life insurance. There's something called non-medical life insurance. And so you're not out of the race if you have cancer, if you have diabetes, whatever. It's just that your premiums might be a little higher, and your coverage might not be as high as what you could have gotten if you had a medical insurance, but you can still get something to put in place. All right, so what can we conclude? The terms of life are hard, but the terms of life insurance are easy. With enough life insurance as a base, an individual is free to invest any extra amount of money in equity products. In times of high taxes and high cost of living, easier terms are most needed when financial pressure is the greatest. So take advantage of, if you have it already, of your life insurance policy. If you don't have one already, speak to an agent, speak to somebody, speak to a financial advisor, and start the process. Thank you very much for listening, and this ends my presentation.